Hello, welcome everyone. Thank you for joining us here this afternoon. My name is Philip Hopley. I'm a partner at Hall & Wilcox in its banking and financial services practice, and I lead the corporate insurance team at the firm. Welcome to this, our ninth event of this week's Spotlight on Financial Services series. Today we're talking about insurance considerations for AFSL holders. Before we start, I'd just like to provide an acknowledgement to country. we're coming to you today from Gadigal land, and we pay our respects to their elders past, present and emerging, and extend a welcome to First Nations people joining us today. As a firm, we've got over 1,000 clients that have AFSLs, and they range from the largest financial institutions to the smallest SMEs. Covering areas of activities from insurance, financial advice, superannuation, and investments. One thing they all have in common is their need to hold insurance cover, particularly professional indemnity cover or PI cover, because it's a regulatory requirement to do so. And as lawyers, we often hear clients express their concerns or frustrations to us about the process of obtaining insurance cover, particularly its cost. So today's session will be focused on answering the questions: how can AFSL holders maximize their prospects of obtaining the cover they need at the price they can afford, and what's the state of the domestic insurance market for PI insurance and AFSL license holder insurance at the moment? To answer these questions, we're very fortunate to have a couple of very experienced speakers from the insurance industry today. My first guest is Sarah Thorne, who is a senior insurance broker at Aon's Financial Services Group. She's joined by Nick Stojewski, a senior underwriter in the Financial Institutions Group of Berkshire Hathaway Specialty Insurance. I'll let them talk to their bios in a bit more detail, but I'll just start with the first question to Sarah, which is just at a basic level. When we talk about insurance cover for AFSL holders, what particular covers are we talking about here? Because it's not just one.
No, yeah. So first of all, just as Phil said, my background, before I joined the dark side and became a broker, I was a lawyer at Clyde & Co in insurance litigation, and then also did a little bit of work in insurance claims, and now I am placing financial lines insurance for financial services clients. So the insurances that we're talking about today, there's a few classes of insurance. First is D&O, which is Directors and Officers Insurance, and gives cover for future, past and present directors and officers of a company for any claims that may arise in relation to their capacity as a director and officer of that company. Within D&O, you also have employment practices liability, which is for claims arising from employees against an employer for or in relation to their employment. We also have crime insurance, which covers financial loss for claims arising out of illegal activities by third parties or employees. And then probably most relevant to today's conversation is professional indemnity, which provides cover for businesses and their professionals for claims from a third party arising out of the provision of those professional services.
Yeah, and D&O would normally capture employment practices liability cover as well?
Yes, so that usually would sit within that policy.
And when we talk about the financial services sector, obviously it's a massive sector. I mean, Nick, from your perspective, can you provide some insight into how an insurer might typically sort of divide up and manage what is a very large sector to analyse the types of risks that it sees?
Yeah, absolutely. Like, it is a very large sector, and I think when we opened our doors at Berkshire Hathaway in 2015, we made a conscious effort to break this down into sort of 4 sectors. The way we consider this is banks, investment companies, insurance companies, and diversified financial services. This one being sort of the broadest group of services being offered, from financial planning to wealth advice to corporate advisors. And the reason we did this is we really want to try to focus on the actual financial product being offered, whether it's a lending product, an insurance product, or financial advice, for example.
Okay, and within those sort of main sort of types of insureds, you've obviously got risks particular to those different groups. I mean, while you're not focused on presumably every category of risk coming out of those insured, can you sort of explain what are the main risks you look at and what really influences and drives your attitude towards a particular insured when it comes across your desk as a risk?
Yeah, so I think like any business, we're always trying to find what works for us, find your niche, find your expertise. And for us, we opened our doors in 2015, as I mentioned, and 2 years later, we had this Royal Commission to Financial Services. Now, if you're in property insurance and you think about floods, earthquakes, or the bushfire season, we call these catastrophic events, CAT events.
Yeah.
And I guess the Royal Commission was our equivalent of our CAT event. So we've opened the doors, and you're probably thinking like it's the worst time to open the doors. Open the doors, and we've got all these claims come through from the Royal Commission. So we're pretty quickly able to assess our current risk appetite. The way we do this is sort of 2 ways. We as an underwriting team, we're trying to assess sort of all the exposures that may cause a loss to your professional liability policy. So this is like considering the specific risks to your subsector. So for example, who's your regulator? How active is the regulator? Maybe a regulator's ASIC, maybe it's ASIC and APRA, maybe it's ASIC, APRA and AUSTRAC. And as we've seen coming out of the Royal Commission, there's been a real sort of change from ASIC in terms of their enforcement and litigious nature. So that's one thing we consider. I think another thing is the overhaul of the external dispute resolution scheme with AFCA. Now, the feedback we've been getting from brokers and also our clients is the determinations being made by AFCA are very much more favourable to consumers at the moment. So that's a sort of consideration we look at.
More than they were?
More than they were, yeah. I think the Royal Commission shone that light. Yeah, absolutely. So it is a difficult space to be in. But from that point, we then work with our actuarial teams to try to assess the likelihood of a loss and its actual cost. So this is probably where it gets somewhat difficult. The reason being is it's more data driven on this side of the fence. So you get data externally, things like APRA data, but unfortunately there is some limitation to how deep you can dive into the data there to specific professions. So the other aspect is your internal data. Now, this is great if you've been around for a couple of decades, 30, 40, 50 years, and you have that proprietary loss claims information. You can feed it directly into your actuarial team, into your rating models, and really reach that point of pricing confidence to keep writing a sector of business. The flip side of that is us, for example, we've entered in 2015, we don't have that history of loss claims data. So when we're looking at a new sector, we really have to bake in a lot more uncertainty into the assumptions we're making before we think about looking at expanding our risk appetite.
Okay, so it sounds like it's not as straightforward as just simply saying we're going to exclude anything that had anything to do with the Royal Commission. And we can't just put a blanket exclusion over that. It's more sophisticated than that, in that you're looking forward to the current, how whatever misconduct in the past affects them as an entity in terms of what that exposes about their risk profile and their approach to risk as a business, because there are forward-looking risks with AFCA, for example, that may drive a particular underwriting response, and you need to understand what's occurred. And obviously, yes, it's the issue around lack of data to help inform that judgment. We'll touch on some of that later on when we come to how do you actually provide that level of information to an insurer.
Yeah, absolutely.
I mean, now that we're now some distance down the track from the Royal Commission, what's your sense of the state of the market each year in terms of where the financial services sector has moved on from there? Are insurers getting their confidence back in a material way, or is that more sort of incremental? What's your sort of view of the state of the market now from that sort of overall risk perspective and looking back on Royal Commission?
Yeah, the Royal Commission was like a real key point for financial services because it was reviewing misconduct over a long period of time, and it didn't discriminate against any type of business. So that has been challenging, but there has been regulatory change coming out of that. So perceived risks should, for underwriters, look better in the future, and hopefully this will introduce more carriers. But in terms of like the general state of the market, probably speak to Sarah because she gets more of a feel from all the insurers, not just myself.
I mean, I guess I can go to talk to that. I guess the state of the market for the financial services sector is quite a broad question because, you know, within that there are so many sub-industries, and the state of the market for each of those can vary quite quite greatly, which then has a flow-on effect to the insurance considerations. But in a broad sense, we are coming out the other side of a very hard market, and this means that insurers have a more flexible approach to not just premiums, but coverage terms and conditions, deductibles, attachment points, and even the types of risks that they're willing to consider. We are also seeing, as Nick said, new capacity coming out into the market, new insurers, particularly in London, and this is helping to drive contestability in the process as well. Something that we've also dealt with a lot over the last couple of years is silent cyber. So,
Yes.
Insurers looking to remove cyber coverage from more traditional policies such as PI to filter that into policies where it belongs, like a cyber policy. So we've worked a lot on those, and most insureds a lot of our clients have had now endorsements added to their PI policies to make sure that the cyber coverage falls under the correct policy. So there are some positive things happening, but there is still a lot of uncertainty in the market. The global economy driven by inflation and the conflict in Eastern Europe. So it's still going to have an impact on insurance. And I think in particular, the PI market for certain segments remains quite challenged. You can pick on probably financial planners and construction there. What we have seen over the last year though is for those professions where underwriting profitability has returned and therefore rates have decreased, that is pushing through to those more challenged markets or segments of the market. But I think the takeaway thing there is that early engagement with your insurers is key.
Okay, so there's an improvement. It sounds like it's more gradual improvement.
Yes, and very dependent on the specific professional industry that you're in.
Yes. And within each of the sort of sectors or the subsectors of the financial services market, do you find that it's a different story for the very large corporate insurers as opposed to, say, the SME businesses in terms of the capacity of the market to meet their insurance needs? Is there a difference in size?
Definitely. I think really, again, it's just about that early engagement with markets, so you have a good understanding of how many markets there are available to you to use, and whether or not we do have the ability to utilise London markets, and there is a lot more capacity there. But again, it depends kind of on the size of business and the risk, and so I think the key is that it's a very individualised approach and not a one-size-fits-all.
Yes, and I assume the London market is really available primarily for the large insurers generally, given that they're obviously offshore, and that's their historical strength. For the smaller insurers, what are the options that they have in terms of accessing cover? I mean, I understand that it's quite common for some brokers and insurers to provide sort of packages of insurance where there's effectively a wholesale purchasing power that can be leveraged to provide that cover for smaller businesses. Can you sort of explain the element of how small insurers can sort of meet their insurance needs from that capacity point of view, leveraging the buying power of a greater number?
Yeah, I mean, well, for example, we at Aon have facilities in place where we have made those arrangements. So if you fit within the parameters of that facility, then you can more easily obtain terms. But I think that probably if you're looking at smaller versus larger companies, the approach that we take when we go to market for larger insurers is, larger clients, is that we probably don't deal with a standard proposal form anymore. We will put together what we call a risk booklet or a risk prospectus, which essentially is a to Z guide on your business, includes all the type of information you would ordinarily expect from a proposal form, and then some, your financials, policies and procedures, anything that you think the insurer might find important. And then we have found that insurers respond to that really well because it's well presented, it's an easy to access document where they can find all the information they need. And then what we ordinarily will do then is have what we call market presentations, where the client will get in front of the market, whether that's a one-on-one with a key insurer or a group of insurers, and allow them the opportunity to ask questions, present your business to them, but then have the insurers have the opportunity to ask questions, It's really important, we think, to get C-suites or executives involved there. It indicates to insurers that you're taking your insurance seriously, and that's a key consideration for your business. And generally, after that, we find that the negotiations should usually be pretty straightforward, depending on the risk. But for smaller clients, whilst we might not necessarily go down the road of preparing a whole risk booklet and a standard proposal form might be enough, what we also will use then is if there are any addendums that might be specific to your business, such as a financial planner's addendum that goes along with the miscellaneous PI proposal form that you use. And then really we would still advocate for an early insurer engagement plan and still getting in front of the key market and getting them to understand your risk. Say, getting in front of Nick from Berkshire and saying, this is my business, this is what we do, this is how we differentiate ourselves. Allow him to ask any of those questions. And then generally then he's able to go away and underwrite it, and he's underwriting it as an individual business rather than, a financial planner as a whole.
Yeah. And do you find that clients are aware of this process, which sounds like quite an involved, time-consuming process that would obviously take place in a period of time, a lengthy period of time, probably leading up to the renewal? Do you find that something that clients are aware of the need for doing and why they understand it's being done?
I think a lot of the clients who probably have been with Aon for a while would be aware of that, but no, certainly not that it's important to start it, 3 to 4 months out. And I think, again, you get that distinction between the large businesses where they are aware, they sometimes are reaching out to us before we have an opportunity to reach out to them. But it is important to get it going early and give yourself the time to provide that information. I think that for the smaller businesses, smaller clients, it probably isn't necessarily that involved. It may just be half an hour with Nick, as well as your proposal form, but it just really allows insurers to build a relationship with you, understand your business, and continue that relationship. I think it's not just a tick box exercise.
Okay. And then what's your thoughts on what you see as a result of the hard work that the brokers put in to present their risks to you? What are your insights on that process? And is it meeting your needs and what you're looking for? How do you normally find how this works for you?
Excuse me. Yeah, there's a massive spectrum in terms of the quality of a submission. I think probably everyone can see that in the market, and a lot of that probably does depend as well on the broker you have. Are they specialists and the way it comes across? But I won't focus too much on sort of poor submissions, but for me, I think the way I see it is anyone financial services that's providing just a proposal form, I feel like you're doing yourself a disservice, because through that proposal form, you're not really going to be able to distinguish yourself or your risk or your business compared to the rest of the buyers of insurance in that space, whatever subsector you operate in. But I guess for me, I'll focus on what I see as the standout submissions and approaches. Yeah. And the way I kind of look at that is 3 ways. The experience of the management team, risk management framework, and thirdly, this is one more probably myself that I focus on is the awareness of the business to understand key risks of their business, both past and present. And so first, I think experience of the management team, being able to showcase the ability of team, who the experts are, the track record, and for sure, as Sarah mentioned, like a call, maybe a 20 or 30-minute call, and really be able to demonstrate your quality. I think secondly, while we understand you're probably really good at your business, what we want to see a focus on is the risk management. Yeah. So what are the internal policies and procedures, the processes? Who's in your audit team? Do you have an audit team? Do you use external audit? Because ultimately, I think, talking to our claims team, where there's claims, there's usually a breakdown somewhere in that back office in a process or a policy. So that's the second piece. And for me, the one I'll focus on is probably, again, the awareness of business to their key risks. The reason I think that is when we speak to our businesses, they really care about their business. And again, you don't get this through just the proposal form. For example, the financial planning sector, say you're an AFSL holder, you have multiple ARs. Yeah. We know that there was an issue there over 10 and 15 years in that failure to manage and oversee your ARs. So how can you demonstrate to us, through maybe the use of software or manual audit, using them together to help manage that risk? Because there's no checkbox exercise in a proposal form that's really going to give any underwriter that comfort.
Yeah.
I think the second, another example similarly is responsible entities. They've sort of been in the spotlight for ASIC recently.
Yeah. And
part of that, what we want to see is as you increase sort of that umbrella of funds that you're responsible for, how can you demonstrate that you're still investing internally in your resources to be able to continue to manage those funds because you are responsible? Another couple as well is, I think, misrepresentation of performance and risks of financial products. That's nothing new, but it's in the current ASIC corporate plan and it's a real focus. So what we want to see here is talk us through your product life cycle, from creation, who's involved. Is it just internal individuals? Do you utilize legal external reviews? And then that accompanying marketing material.
hopefully.
Yeah, I hope so. Give Phil a call. And so it's like the next piece here, that marketing information. For example, I think a fortnight ago there was a superannuation fund that had an infringement notice based on the ESG marketing of one of their funds. Yeah. So talk us through, once the product's been created, is there an annual review? And in next year, do you review that the statements made in your product or your marketing material is still suitable or up to date for the current risks? Yeah, and I think finally for me, it's like complaints register. I think people get, or insurers when we speak to them, get scared of maybe supplying that information. It's not like motor insurance. You're not sitting there going, I don't want to sort of disclose, or maybe I had a ding or a dent in my car and they're going to penalise me 50% of my premium. It's the complete opposite for me. We want to understand, every business has complaints, how you're identifying them, how you're working through the complaints handling, and more importantly, what lessons are you learning and how you're re-implementing them back into your business to continually improve your business. And for me, ultimately, they're the insureds that are going to, being able to demonstrate that will achieve the best outcome in their insurance renewal.
Yeah, the complaints register can be a good news story to insurers.
Yeah,
it's
not a confessional exercise.
No.
You can see how it's tied into risk management, and you only have to read ASIC's insights into the reportable situations regime to see that its main concern is that people just don't know that there are issues going on. And yes, it all has to go into the complaints register, whether it's reported or not, because they want to see the drivers onto the risk management side to see improvements being made, lessons learned. And I would imagine you want to see the same thing as well. You want to see not just what has occurred, but what the response has been from a risk and governance point of view, what uplifts have occurred, so you can be confident it's not going to, what has not been reportable will eventually become reportable in any claim. So yeah, I can understand that, but that's good to hear. And while we as lawyers focus a lot on what ASIC says about its enforcement priorities and individual enforcements, and greenwashing is a great example of where they've been active recently. Similarly, you don't necessarily think of underwriters also keeping close tabs on what the regulators are doing just as part of their general awareness around financial services underwriting. But is that the case, that you're equally up to speed with exactly what is occurring, not just through what you see through your underwriting submissions, but you have a broader industry lens around hot topic areas that you look to see your prospective insurers demonstrating that they're aware of if they affect their business? Is that right?
Definitely. Yeah, it's one thing we focus out at Berkshire because it's almost ASIC's a bit of a lead indicator of where claims will arise in the next sort of 12 to 24 months. Yeah. So I think it's really important for a business to demonstrate that they're aware of those risks. Yeah. And how sort of getting ahead of the curve, because eventually, as we know, sort of you'll see it in the media, they'll come in 1 week and then ASIC will go after me 3 or 4 matters in the same week around the same topic. So I think that's why I sort of said focus on those key risks. It shows that you're really caring about your business's reputation, not only to past risks, but future risks as well.
Yeah. And in terms of what difference a good, bad or indifferent submission makes, is it really the difference between getting cover or not getting cover at all, or are we just talking about price or exclusions? Can you give me sort of any sort of steers around how you might respond where you just haven't got what you were expecting or would like to receive in a perfect world?
Yeah.
So you can say things generally.
Yeah, no, it's a good question. I think, like anyone in any business, whether in financial services or you're a truck driver, people are always busy and time poor. So when it comes to doing a job, which is for us reviewing risk, if you simply get for example, just a proposal form and there's no context, there's no additional disclosures around risk, it's just unfortunately a matter of like, I'm too busy. I'll go look at the one sitting next to it, which is maybe got a risk booklet or a complete sort of review of the business. That way, then I feel like I can provide, I can review the most information. It's going to provide me with the most comfort to get to the point to firstly provide a solution, and then depending on the quality of that submission, hopefully the lowest deductible for the client and a competitive price.
Or even, if it's not the risk booklet, the proposal form plus a request for the managing director or the CEO who'd like to sit down with you for half an hour and answer any extra questions. It's just demonstrating that you're invested in making sure you have the right insurance, probably.
Yeah, and do you see that willingness for insurers to come along with their C-suite or offer them up or be aware that that's actually a really important thing to do?
I think generally, but I think it is also the broker's role to effectively communicate why that's important. And so I don't think that there's too much pushback if you have that relationship and you're able to say and explain why that's an important part. And I think probably over the last couple of years, obviously with the hard market, probably had a lot more engagement from high up because the premiums and coverage hasn't been ideal. So I just think it's about building the insurance process into your business plan for each year and knowing what's involved in it. I think it pays off, as Nick has said.
Yeah. I presume you draw comfort from that investment of time that the executives are prepared to make to meet you, because I imagine as well that even if they have provided the all singing or dancing proposal information, that it's still a lot of information for you to get across in a short period of time. So how do you feel when you do or don't see executives? I mean, does it always make a difference for you? Is it always better to have seen people? Because I appreciate that sometimes you may come away from meetings feeling less confident perhaps than you went into them, but hopefully that doesn't occur, but that's a possibility. I mean, how do you feel as a person to whom they're entreating to provide cover? Yeah,
for me and for our business, we're always employing to try to get in front of our prospective customers and our current insureds. We want to, if they're a current insured, we want to keep learning more about their business. The more we learn about them, the more confident we are, the more seamless that renewal process will be, and hopefully the more stable the insurance outcome for the customer. And for new, definitely want to meet them, because at that point, it's like a blind date. You don't know who they are, like how you're going to commit to a relationship. So for me, getting in front of the client only ever helps. Yeah, sometimes you might go away with less confidence. I think the point of the calls as well is like you can really focus, as a proposal, what the key issues to their business are. So over a call, no one knows the business better than the management team. They can talk you through whatever the internal control processes may be, or their approach to greenwashing, for example. So it's more pointed, and for me, it's just the most effective part of the process.
I imagine for you, Sarah, there's a phase where you need to prepare the management team with potential questions and topics so that when they're asked, they don't, they're prepared and they can give a good account of themselves. Is that something you do and provide guidance to clients?
Definitely. So probably the first thing we do to kick off the renewal process, be that 3, 4, 5 months out, is have what we call a pre-renewal strategy meeting, where we go in and meet with the client, and we will usually ask from them at that point for a business update, anything that we need to be aware of that we're not already aware of from the last 12 months, and then sit down and talk to them through the state of the market specific to their sub-industry, talk about what their current insurance placement, what they've got in place from the previous year, and then also what our strategy is probably to be for the next year, what they might want us to take into account, what we see as perhaps issues that might arise or that we'll need to address. And then what we will get them to do is go away and prepare their submission, however that ends up being, as we've discussed. And then usually depending on the business, it might just be a sit down and have a chat through the business, or if it's a full market presentation, we'll get them to prepare some slides. But I think the insurers aren't going to ask, if it is the management team, they're not really going to ask a question that you don't know about your business. It's just, we would give prompts around things that insurers are particularly interested in at a certain time to make sure that you're ready. Yes, yeah, and make sure you have, if the relevant personnel on the call. So it might be, your cyber or your legal counsel or your chief risk officer, so that you can talk to that, or your CFO. But yeah, it's not designed to trip you up, really.
Okay.
I think the best way to think about it is that it's a relationship that you're going to build, and if you don't put any time into it, you're not going to get much out of it.
You want that second date?
Yeah.
Well, insurance has always been famously so, one based on personal interactions and personal relationships, and you can see that playing out here. Do you ever sort of make submissions around risks and then sort of liaise with the underwriter to sort of get some initial feedback, and then have an opportunity to then sort of augment or supplement it, or prepare the management team based on some initial feedback? So again, you can enhance what you provide to the underwriter. Does that happen?
Yeah, I mean, definitely. Usually what we would try and do before that initial strategy meeting with the client is have a conversation with their incumbent, which is the insurers currently on their program, and say, might be a little far away from this renewal, you might not have thought about it, but I'm meeting with the client in a week or two. Can you have a think about anything? Is there anything that comes to mind that you're going to have an issue with? Have you got issues with your capacity? What type of things should we be looking at or expecting to need to talk to you about? And so that also is really helpful as well.
Right. And Nick, what's your insights on giving that sort of feedback? Do you feel comfortable doing that? Does that help you?
Absolutely. It actually makes the process more efficient and transparent. So I get a call from Sarah. So what are your thoughts on this? And it might be 6 months in advance. And we know the more information we give them early on in terms of concerns, the easier they can prepare the information to address those concerns and alleviate those concerns.
You can see it's really, it's not just a once a year process, really, isn't it? It's one that continues throughout the year, albeit with periods of activity, and then you've got the cover, but it's not just a set and forget thing from the broker's point of view, of course, because you want to make sure that the client maintains and improves, and you stay on risk, and you want this to be a long-term relationship. Berkshire Hathaway famously always keen on long-term relationships. So yeah, it's interesting. I didn't quite appreciate it was such a lengthy, full year process. You don't just sort of put people away for the next 6 months.
No, finish, have a little holiday, and then start all over again.
Yeah. I just want to sort of talk next about RG 126 compliance, because that's an important feature of professional indemnity insurance in the AFSL holder space. And just by way of background, AFSL holders are required by law to hold what is statutorily required to be appropriate PI insurance, and ASIC provides guidance around their views about what meets that appropriateness requirement. And for example, there are certain minimum standards of cover around cover for Chapter 7 breaches, obviously fraud and dishonesty, covering all of your representatives, a limit of at least $2 million, anyone claiming in the aggregate, and then areas which are not often well understood by corporate insurers coming to this the first time is that there has to be at least one reinstatement of cover provided, defence costs in addition to the minimum limit. When you're approaching sort of this PI cover, some of these are quite, well, not onerous, but they're different to PI requirements you typically see, and you wouldn't obviously have them in other sectors that weren't regulated. How does Berkshire Hathaway deal with RG 126 compliance in terms of ensuring that its policy ratings have this, and is that sometimes a problem for it in terms of the particular risks that it sees?
Yeah, that's a great question. From our perspective, when we look at RG 126 compliance, we look at it more from a coverage perspective and having the right cover in place from policy form. So what we do there is, if it's requested from the broker and the client and they need my RG 126 compliance, we have a special endorsement that applies our policy. That covers the things you mentioned, like the authorised representatives and damages pursuant to external dispute resolution schemes. So from our perspective, the coverage is there on request, but ultimately you still need to get through the underwriting process in terms of that we're comfortable with you as a business. Ultimately, when we put forward the quote on the policy form, and then you'll have your RG 126 compliant endorsement.
Okay. Is there anything more that the insurer needs to do generally to get that sort of endorsement, or is it just part of the holistic underwriting process that they're going to do anyway? Is there anything special to get the RG 126 tick?
No, it's just part of we understand that the sector that they're operating, that they need to have RG 126 compliance, and then it's just part of the process, and then that part of the negotiation of getting to the point of whether you want to issue terms And then if you do, then we'll apply that endorsement.
Okay. And sorry, if there's not an endorsement already obvious on the front of it, how do you determine whether a policy that you're seeing, if say someone's coming to you with an existing insurance cover that they're looking to renew and use Aon to broker that year, how do you tell if it's RG126 compliant? How do you see ones that aren't RG126 compliant? How do you deal with?
Yeah, I mean, obviously we'll review it to ensure that they have, and if not, ask the insurer to include that to make sure that it is RG126 compliant. But I think probably from my perspective, what we've seen more is in respect to the limit that they're purchasing. So I know you mentioned that you need to have at least $2 million worth of PI limit if you have for retail revenue. What I have seen a few times is where a client will come in and their PI limit, once you have more than $2 million of retail revenue, you need to have the equivalent level of PI cover up to 20 million. And so what I've seen is where a client will come in and they might have, $60 million of retail revenue and they've only got $15 million of PI cover, so they're not compliant from the limit perspective, so they need to have at least that $20 million limit. So that's one of the key things that we would review and then make sure we go out and get enough insurance for them to cover that. And I think that's really important and needs to be reviewed probably yearly to protect your business really.
As revenue changes.
Yeah.
One thing lawyers are often asked to comment on is adequacy of limits, and that's not a legal question. So presumably you give formal advice and do formal assessments, because as a broker, to provide advice about this is what you should be looking at as a limit. Is that right?
To an extent. I mean, I guess we would probably never tell a client, aside from the fact that if they're not RG126 compliant from a limit perspective, we would tell them you need, like, your revenue's X and your limit is only this. But we wouldn't go and tell the client you should buy this limit, but what we will do, or what we can do, is provide guidance with benchmarking that we have. So we pull all our clients' data and we can provide some guidance around, this is where you sit in relation to your peers for PI cover. So take that away and consider that, and it's a business decision then from, the business's risk tolerance, how much they're looking to purchase. But we probably would steer clear of telling them exactly how much cover they should buy. I think that could become an issue.
I'm sure it's the benchmarking that I find helpful. Do you similarly find yourself benchmarking or asked to comment on levels of excesses that the businesses carry? Because one feature of previous years was obviously one easy way to ensure your insurance premiums are lower, or at least not too high, is to carry an increased excess. But do you get asked to comment on that as well? Because that's an important factor for RG126 compliance, but does that feed through into the discussions around limits or not so much?
I think it's not really whether you have excess or not, it's what limit do you want to purchase, which might be $50 million. And then you build a tower up to $15 million. So you will find a primary insurer, and depending how much capacity they're willing to deploy, that might be 5 or 10 million usually. And then you'll need to find insurers beyond that 10 million to build it up to the $50 million limit. So it's not so much whether or not you have it all in primary or all in excess. It's just you have a limit, and we will find coverage or insurers who can deploy coverage up to that amount.
Yeah. I mean, you must see these structures as well. I mean, one issue that has cropped up occasionally is that you'll have AFSL license holders within a group where there is some intra-group support being provided that's not insurance, it's more of a guarantee or some capital support, and that's effectively providing a primary layer. And there's questions around whether that's actually permitted, and ASIC states that you should get its approval, but to my knowledge, people don't generally tend to ever seek that approval. But do you see those sorts of structures yourself, or is that really just more of a marginal thing in terms of the insurers that come to you that have got existing towers where you're just fitting into that?
Yeah, we don't see it often. It's probably once every 6 months. There might be a discussion with a broker or a lawyer, and it pops up, we might explore that approach and look for an exemption with ASIC. But generally speaking, I think it's all hands on deck, working with their broker, working with the insurance market to try to find either that $2 million limit or whatever it may be. And from our perspective, that's the majority of the solutions we see in the market.
Yeah, presumably you've got a significant primary layer that you can bring to any risk. Is that fixed particularly, or will that change depending on the size of insured you're dealing with?
Depends on the size of. It depends on the size of the organisation, how comfortable we are to deploy, whether it's $2 million or $5 million or $10 million or $15 million. That all sort of falls into also our approach to portfolio management. You never want to be too exposed, to one giant limit, to one giant organisation. So that obviously affects. So it does feed into sort of portfolio management, average limits, and what we can support. Ultimately, what we try to do is we've committed to a client. They have a claim. If we pay the full limit, ultimately what we want to try to do is commit that next year we can deploy that exact limit again. And so that's the commitment we're trying to put in place. So to do that, you can't have $50 million on every single limit. Otherwise, it just doesn't make financial sense. So it's all about managing a portfolio. And as we grow, that changes with annual reviews as well.
And the premium pool at the moment in Australia, is it sufficient to meet claims in your experience? We're not in sort of old D&O territory here. Is PI cover looking okay in terms of capacity?
It's a good question. Probably everyone, my peers want me to say no.
It's very hard. It's still very hard.
Yeah, it's still difficult. I think it's been specific to financial services. That time from sort of 2016 onwards with the Royal Commission, and there have been large losses that have been paid by the insurance industry. Now, unfortunately, the way I look at that is it does skew in terms of losses paid are to the largest organisations, and that's the unfortunate side of the principle of risk sharing, where all these other organisations that are in that kind of middle market size organisations are sitting there going, hold on, my business hasn't changed, the size of my business hasn't changed, my team hasn't changed, nothing's changed, but my insurance has gone up 25%. The year after, it went up 25% again, went up maybe 10% again. So why is this happening?
You've pulled your risks is the reason it's happening, isn't it?
Yeah, so that was the sort of, I guess, the knee-jerk reaction from certain markets, whether it's some local markets or markets in London, after the Royal Commission, followed by COVID as well. There was a contraction in capacity being offered. And unfortunately, the way the risk pool works is everyone shares in the pain, and that was the general lift in premium increases. So I think the pool has increased. Is it sufficient to pay all claims right now? I'm not sure. But I think ultimately the insurance market is a pretty good market in finding new capacity where there's opportunity. So right now we're seeing new capacity. So that probably tells you that those players think that the pool is sufficient to cover claims. But again, I'm not going to say yes or no, because but I think it is a good place at the moment in terms of the market right now and opportunity for clients purchasing insurance compared to the last 2 or 3 renewals that they've had.
Do you think I was going to say, I want to sort of move on next to how you see the market going forward. Do you think it's markedly improved, or is it just a process of gradual improvement? Because, anecdotally I heard last year was the first year things were getting a bit easier, but is it just the same again, or is there been a more significant shift occurring, or will that occur over the next 6 to 12 months in the PI market, do you think?
Yeah, I think the feedback I'm getting from brokers and clients and just in terms of like competition means that I'm seeing a gradual improvement. I don't think it's just going to be a complete drop and go back to sort of maybe what you were paying in 2015. But what we are seeing is maybe a flat to small decreases, single-digit increases this in the first 3 months of this year. Yeah. And again, with the feedback we're getting with lots of more London capacity or even local insurers re-entering certain pockets of financial services, that can only help the insurance purchaser. So I do see it's going to be a better time to buy insurance. Hopefully, you'll get a better outcome this year compared to your previous renewals.
And do you think Berkshire will be wanting to increase its market share in the PI and AFSL insurance space generally for financial sector organisations, or do you think it's going to stay roughly where it is at the moment? Yeah,
so good question. So we try to price ourselves as being a stable market, but with that, unashamedly, we want to make profit like any organisation. So we want to grow and grow profitably. So it's not a situation of we just want to increase market share to increase our top line. We want to, as sort of mentioned that first part of the discussion, we spend a lot of time trying to assess other pockets and get feedback from brokers and clients say, hold on, you might be missing a trick here. This is actually a part of the financial service sector that's performing really well. That's just been tainted by some issues 10 years ago, but it's changed. So we absolutely want to grow, and I think it's an opportunity for brokers and also industry bodies within these sectors to provide feedback or provide us with maybe more information or improvements in their sectors to sort of not entice just us but the market to provide them more data and confidence and then that will only help the industry provide more options for their customers.
Okay. So what's your sort of outlook on how do you currently feel the market is sitting, and what do you think is going to happen based on the feedback you're getting from being at the pointy end and actually having to place this cover?
Mm-hmm. I mean, I don't have a crystal ball as much as I'd like one, but I think, as I spoke to earlier, we are seeing positive changes in relation to the state of the market for insureds and for clients. And whilst the global economy is probably in a state of flux, I am cautiously optimistic. I think as a real-time example to use, I know we've talked about financial planners a lot today and how they've had a rough trot and still continue to be a challenged area, but I've just finished a couple of renewals for some of my large financial planning clients, and for the same renewals last year, we had no alternative options outside of their incumbent or the current markets on their programs. So we really were between a rock and a hard place in terms of any premium increases, or in fact trying to convince them to stay on and retain the levels of limits that they were purchasing. For those same renewals this year that I've just finished, we had multiple options. And whilst we actually ended up staying with a lot of the incumbents, those options helped drive contestability into the process and certainly helped in relation to coverage and premium and deductibles. So I think that's a good way to show kind of where the market's going and what's happening. Hopefully it continues.
And is that focused across the market, or is it focused more on the larger insurers that have access to that competition of the London market? Do you think, or is it hard to say?
Well, one of these clients is a lot larger than the other, if I stick to this specific example. One of these clients has had access to the London market before and the other hadn't. And we were able to use that for both. I actually have seen one of the questions come up about UFI, so it's kind of relevant, unauthorised foreign insurers. So a lot of some markets in London who aren't authorised by APRA, it can be difficult for clients here to access them.
Yes, of course.
But there are certain instances where where you are able to, size of your business, if you're above a certain threshold, you can. Yeah. But another way is if the terms and conditions that are coming out of the London market are so it would be detrimental for you not to be able to access that, then you can place your insurance with that market, and there's a process you go through, and we do use it a lot for our clients, so it certainly is an option that we look at. So I don't think the London market is off limits for those smaller insurers and clients, and in the case of my smaller financial planner, that did help drive contestability with the local markets, and I think we ultimately ended up using the local markets, but it's certainly helped drive the conversation.
Yes, you can often tell what stage of the economic cycle you are when insured clients come and start asking you about whether they can purchase insurance offshore. And it's always useful. I'll just ask one last question before we have time for questions. If people want to ask any questions, we've got a screen here, and we've got about another 10 minutes or so that we can go through and answer any questions that people have. But I guess my last question was, if you had one piece of advice to tell prospective insurers today about what they could do at their next renewal, what would your advice be, in terms of the one thing you would say? Maybe you can say.
Well, I think probably the types or the classes of insurance that we're talking about today are quite complex in nature, and the types of claims that arise out of them are complex in nature. And then probably if you think about the financial services sector, those are complex businesses as well. So I think that having a specialised financial lines or financial services broker is really important, because they are seeing clients from across the sector, so they have access and experience dealing with similar business risks. They have relationships with key markets and know how to properly market your risk to those insurers, and they can help you throughout the process and make sure that once you have those policies in place, they are fit for purpose, and they are for your business, and they're going to do what they need to do, which is pay claims when they arise. So I think that a good financial services broker can be a trusted advisor and can be an integral part of your business.
Yes, well, like any specialist advisor, they can deliver value which is worth obtaining Yeah.
Yes, and I'm obviously biased, but
Well, I would say the same in your position as well. Like there is a value there that can sell you. Nick, what's your advice to people about to cross your threshold? What's the one thing you would ask them to do or advise them to do?
Yeah, for me, I think genuinely we meet so many good businesses once we get the opportunity to meet them, and these businesses care about their business and care about risk. That doesn't always come across. So my advice would be focus on the key risks that really are to your business or to your sector, and demonstrate that. For example, things that happen on the Royal Commission, if none of that affected you or you didn't have any of that conduct, showcase that, demonstrate that through your submission with your broker, and really sort of highlight those key points. I think that would be my final piece of advice.
Okay, thank you. Just going through the questions, one question which is prompts me that we didn't really talk about the sort of flip side of the UFI equation sometimes in clients' mind is whether there's been a growth in discretionary mutuals as an alternative to insurance, as a cheaper alternative to insurance. And I know that firms such as Aon often do a lot of work in that mutual space. Has that been something that you've seen or heard much of? There's been an increase in use of mutuals, or similarly with Nick, clients moving off to a mutual structure, which you then come in as an excess insurer for? Have you detected much appetite for that kind of structure?
Yeah, sure. Definitely, probably from about 12 to 18 months ago, I guess, with such sort of not radical, like drastic increases in that space, people are looking for alternatives, and one of them within the financial services sector has been discretionary mutuals. I think part of that is a lot of sort of organisations operate in mutual industries. Maybe they're in private health insurance with mutual structures, maybe it's credit unions and building societies. So I think there's an appeal there within those groups to work together and look for solutions. I haven't sort of really seen one. Like any business, it takes time. There's a business plan. It takes time to if it's going to work and get on foot. So I haven't seen any sort of move into that type of solution yet. But I believe that it's definitely at front of mind for the customers, and there's people out there that are looking for those types of solutions.
Yeah,
I mean, I haven't specifically dealt with it myself, but had one client start to have a look at it probably last year. But as the markets turn, obviously, then it's a big undertaking. So
yeah, I mean, it's a big undertaking to set up that mutual process.
Exactly.
And there are ways to sort of try and you can outsource parts of it, but it's still quite at the bottom line, you're still operating effectively in ways very similar to an insurer yourself. So it's probably something that larger insurers look at. One question we have, I suppose I can break this down into sort of the larger and the smaller insurers. If you could sort of say in very general terms what the sort of normal time to turn around getting a policy in place for approved would be, do you have a kind of what your normal expectation would be for that kind of large and small insured seeking, which is an AFSL holder in the financial sector space? Do you normally get advice about time periods?
Well, our approach is to start 3 to 4 months out, really, regardless of size. As we've talked about here today, I think it's not a travel policy. They're complicated policies to put in place, and you want to make sure you have the right one. It's not a one-size-fits-all policy, and it's not a one-size-fits-all, like the businesses are so different. So I would say 3 to 4 months, but I guess, if it's a quick turnaround in urgent, I would say a month, but that wouldn't be, getting a policy in place and approved, you really need that time out. You need the time to prepare the submission, speak to the insurers, look at it, and then probably in the month before the policy renews, you'd be looking to get terms. And then you need time, if those terms aren't great, to negotiate and talk to other insurers. And then you need time, particularly for clients to take it and get approvals. So it's not a quick process.
Insurance you get done in a week or two. It's a process. And you'll get a better outcome, obviously, the more prepared and more time you allow yourself, I imagine. We're getting close to 30 June, so I'm sure there's still time for people to put in their submission.
Squeeze timelines at 30 June for sure.
We have one last question about the Royal Commission. The question was, this is probably for you, Nick, I suppose. Do you see the activity dissipating now that we've had the Royal Commission in terms of regulatory activity, or do you see particular focuses, or do you just think there's no pattern to the behaviour? I mean, I know you talked about, you were aware of ASIC's enforcement approach, but do you generally see regular activity is now just at a baseline of active, or do you see it coming in fits and starts, or are you not quite sure what's happening at any one time and it always changes? I mean, do you have a view generally around how active the market is now that we're through the Royal Commission?
Mhm. Yeah, I guess us as insurer, because we're insuring always the downside, we're kind of pessimistic when it comes to this. So we see is the regulatory landscape being as active and probably remaining active for the foreseeable future. Regulators got a bit of stick sort of going through a Royal Commission that they were a bit lax in their approach prior to, so 10 years prior. So now that that's changed, I can't see them going the other way. In terms of sort of focus on behaviours or industries, the ones you see in the headlines are probably going to be the larger organisations, but it doesn't mean that if you're at the smaller end that you can't, that you're going to avoid those sort of inquiries from the regulator.
Yeah.
So personally, we review regulatory risk sort of all the time. I think, changes as well, like now if you're an insurance company with complaints handling being part of your financial service, and there's ongoing investigations now. So it's always sort of changing. So I don't see it as reducing. I think it's a key concern, and if you're a business and you focus on that, I really think you'll stand out in terms of your submissions, and you should get a better outcome when it comes to insurance renewal.
Yeah, thank you. And there's a lot more regulation that's now in place since the Royal Commission, of course, and that is now being enforced. You just think of the DDO regime, where there's focus on T&D quality, for example.
Absolutely.
You've got that as now. You've got reportable situation issues, claims handling as a financial service, now a whole new area of conduct to enforce, because of course the complaint was it couldn't be enforced effectively. So now of course we'll probably see some enforcement activity, even if it's historic in nature. I think of all those NCAP
Definitely
losses. So,
and the difficult thing for us is being insurers is when claims come, they generally arise from conduct from the past, as you mentioned, and that's why it's difficult for an insurer to sort of be super confident into sort of re-entering this space. While it remains active, the positive thing is this generally cleans up industries, improves conduct, improves behaviours. So over time, it'll absolutely, I believe, have a benefit to their customers, because it will provide more confidence to underwriters entering that space. So I think with time, but it's just like most things, like it's sort of a bit slower in insurance, in the insurance world.
Well, I can see how insurers and brokers help drive that risk and governance uplift improvement by increasing awareness. If you weren't already aware from the regulatory enforcement, you're actually promoting a proactive response, and you're financially rewarding through lower premiums the behaviour you want to see. So,
Yes.
you can see ultimately how you feed into that cycle of uplift in terms of the quality of the professional services that AFSL licence holders are providing.
Definitely.
Okay, we don't have any more questions, but thank you very much indeed for joining us there. We really appreciate your insights. It's been very interesting to talk to you. Thank you for giving up your time, and thank you for those who've tuned into our webinar today. We have one final event tomorrow. My colleague Anne McNamara is going to be talking about superannuation, and she'll be answering the question of how superannuation trustees can help members meet their retirement income needs. Pretty big question, so if you tune in tomorrow, you'll be able to hear her and the panel that she has answer that question for you. Thank you very much for joining us. Enjoy the rest of your day.
Thank you.